Let's turn to our panel. Scott Brown, chief economist at Raymond James, John Lynch, CIO at Comerica Wealth Management. Scott, let me start with you. If I heard Steve say the word modest once, I must have heard it 7 times there. Everything is modest right now in terms of the economy. Do you disagree?
Well, I think you always have to be careful when you're looking at January numbers. We normally see the economy really cooling off before you get to the seasonal adjustment. But you're coming off a relatively soft holiday shopping period, so you had mild weather in January. So I think a lot of the numbers are going to look pretty good. We may see some moderation in the February numbers because of the bad weather and everything. But we're still a long way from a full recovery, and obviously we're going to have to wait till the pandemic is behind us and you get that rebound in consumer services. You've had some increase in spending in terms of consumer durables, actually a lot higher year over year. We think that's simply because people can't spend as much money on services, so they're going to find something to spend money on. You've had a lot of aid, support. And normally people that wouldn't be getting unemployment benefits are getting unemployment benefits now. You've had checks that have gone out, and another check is going to be on the way probably in a few weeks. And all of that, I think, is a pretty positive outlook for the consumer. But again, it's all about the pandemic.
Yeah. John, let me turn to you and ask how you see the economy presently and moving forward into the second and third parts of the year, and how you see the market reacting. Obviously, lately, the market seems to be reacting most especially to interest rates, the tech stocks, as Bob Pisani just pointed out.
That's right, Tyler. Good afternoon. Yes, certainly the market is anticipating, quite frankly, anything other than modest. If you think about 1.9 trillion in stimulus, maybe 1.3 trillion in personal savings. So I think what the Treasury market is telling us right now, with all that stimulus, with the pent-up demand, Scott made a good point about spending on durables as opposed to services or experiences, but it does appear that's about to change. And while we might be modest or beige, as the book is identified currently, I do think over the next few months, the market is telling us that we're going to have a surge in liquidity, and I think that's why the 10-year is moving. It's fascinating when you see big tech pulling back, but even with last week's weakness, the equally weighted S&P 500 outperformed, and if you think about a year-to-date number, it's probably twice that of the cat-weighted S&P 500. So I would view that as a positive, because the average stock is starting to gain traction. And I think that's better than when you just have Big Five leadership like we had for much of last year.
Shepard Smith here. Thanks for watching CNBC on YouTube.